What I'm about to tell you will sound insane, but by the end of this video, you'll understand why a single metal ignored by Wall Street, dismissed by mainstream media, is about to trigger the biggest wealth transfer of our generation. This isn't speculation, it's mathematics. Right now, the world is standing at the edge of stage 5, a phase that won't just lift silver prices but permanently change how they form. Most people don't see it coming, yet the signs are everywhere for anyone willing to connect the pieces. To understand why this moment is unavoidable, the story must start where they appear overnight. It's the product of a long chain of events stretching back to 1999, each stage tightening pressure on the next. Stage 1 was the forgotten bottom. Silver sat near $5 an ounce, unloved and unnoticed. Mining companies struggled to survive. Investors ignored precious metals entirely. It was the lowest point in modern silver history, and almost nobody cared enough to look deeper. But during that quiet and overlooked year, something important shifted. Central banks stopped selling gold. After decades of unloading metal into the market, they halted their sales. This subtle move signaled the end of a long bear cycle and the silent start of accumulation. The world barely noticed. Tech stocks were booming, the internet was exploding, and capital flowed anywhere except metals. Yet beneath that surface excitement, the groundwork for a massive reversal was forming. Stage 1 created the base layer for everything that would follow. Then came Stage 2. The 2008 financial crisis tore through global markets. Banks collapsed, economies froze, and policymakers unleashed money creation unlike anything seen before. Trillions poured into the system to keep it from falling apart. The impact on silver was immediate and furious. Silver shot upward with shocking force. From around $9, it raced toward $50, climbing more than 500%. The speed stunned investors. Even after the crash that followed, the surge revealed how violently silver reacts when currency expansion reaches extreme levels. Many dismissed the move as a bubble. They said the decline invalidated the entire rally. But they ignored the real signal. Stage 2 proved that silver is hypersensitive to monetary distortion. It responds directly to uncontrolled liquidity, making it a mirror for currency instability. The correction didn't contradict the pattern, it confirmed it. Silver's volatility runs in both directions, but its connection to aggressive money printing had become undeniable. Anyone studying those years could see a repeating rhythm forming beneath the chaos. That rhythm reappeared in Stage 3. In March 2020, global shutdowns froze supply chains and paralyzed industries. Central banks reacted instantly with enormous money creation, far surpassing 2008. The timeline was shorter, the amounts larger, and the consequences even sharper. Silver reacted almost immediately, rising from $12 to around $30 in a few months. But Stage 3 introduced something new, something powerful. Millions of retail investors entered the market, creating a force the system had never experienced on this scale. Online communities coordinated buying waves, drawing attention to physical shortages and exposing vulnerabilities in the market structure. Bullion dealers were overwhelmed. Their websites failed under demand. Premiums soared as everyday people drained available inventory faster than the system could replace it. Physical silver became difficult to obtain at standard prices. The gap between paper contracts and real metal widened dramatically, revealing stress points the market had long ignored. It was the first time ordinary participants had pushed the silver system to its limits. Even though prices cooled afterward, Stage 3 left a permanent mark. Retail buyers had proven they could influence supply conditions. They showed that physical demand could strain distribution, challenge liquidity, and force a spotlight onto weaknesses hidden inside paper markets. This shift brought silver into Stage 4, the phase unfolding right now. Unlike earlier stages, Stage 4 is not driven primarily by speculation or money printing. It is driven by something much harder to stop, the physical limits of supply. Global mine production peaked years earlier and has been declining ever since. New discoveries are increasingly rare. Existing mines are aging, and because most silver is produced as a byproduct, supply cannot quickly expand even when prices rise. At the same time, industrial demand is climbing at a pace never seen in silver's history. Modern technology relies heavily on the metal. Solar energy, electric vehicles, advanced electronics, communication infrastructure, and medical systems all depend on continuous silver consumption. Industrial demand alone absorbs the majority of global output, leaving only a thin margin for investment. Before ETFs or private buyers enter the market, most annual production is already spoken for. The remaining buffer grows thinner each year as new technologies multiply. ETFs contribute to this squeeze by locking away enormous amounts of silver. these holdings rarely return to circulation. Once vaulted, that metal stays immobilized, removed from active supply, deepening the shortage and tightening pressure on available inventories. The result is a structural deficit. For several consecutive years, global consumption has exceeded production. Above-ground stockpiles are shrinking. COMEX inventories continue to decline quietly, revealing a system that relies on reserves steadily draining toward levels that cannot support current demand. These conditions invite comparisons to the Hunt brothers episode, but that event tells a very different story today. Back then, the system was able to respond with powerful interventions because massive reserves still existed and leverage rules could be changed quickly. In 1980, exchanges raised margins, governments stepped in, and interest rates soared. The forced liquidation crushed the squeeze. That world no longer exists. Today's pressure doesn't come from two individuals. It comes from millions of buyers and industries that cannot simply walk away. Industrial users do not reduce consumption easily. Technology doesn't pause because prices rise. Energy grids, factories, and medical systems all depend on silver. Their demand continues even when supply tightens, creating a scenario far more complex than the Hunt era. This widespread reliance means the system cannot rely on quick rule changes or a handful of policy tools to stop the momentum. There simply isn't enough spare metal left to absorb new shocks. The market is entering territory where old methods no longer provide stability, and that is why Stage 5 is unavoidable. It represents the point where physical scarcity overwhelms paper pricing, where the market stops pretending supply is unlimited and begins reflecting reality. Once Stage 5 ignites, silver will never return to its old price structure again. Stage 5 begins when the world discovers that the paper market cannot supply the physical metal promised on its contracts. The moment enough buyers demand delivery, the system reveals its limits, creating a chain reaction that reshapes pricing across every level. This turning point doesn't require a dramatic collapse. It only takes a surge of buyers requesting real silver at the same time inventories are already thinning. Once delivery delays begin, confidence erodes quickly, forcing more participants to chase physical supply. Industrial users react first, securing extra material to protect their operations. These companies know they cannot risk shutdowns caused by metal shortages, so they begin purchasing aggressively, absorbing remaining inventory, and reducing the availability of silver for the broader market. Their sudden demand creates a new problem. Other manufacturers recognize the tightening conditions and also begin securing inventory, turning normal purchasing cycles into defensive stockpiling. This behavior pushes the market closer to a point where supply becomes visibly strained. While industries scramble, investment funds realize the paper system is losing credibility. They start converting contract exposure into physical holdings, moving metal out of accessible pools, and into private vaults, where it no longer supports the futures market. ETFs face mounting pressure as investors request shares backed by real metal rather than promises. These funds must either acquire significant new silver or admit they cannot meet redemption demands, a scenario that accelerates the shift toward physical scarcity. As more ounces are removed from circulation, the futures market faces an uncomfortable truth. The number of outstanding paper claims far exceeds the physical metal available. This imbalance forces participants to reassess how contracts should be valued under tightening conditions. Dealers begin raising premiums sharply as their inventories thin, revealing the widening gap between the futures price and the cost of obtaining actual metal. This disconnect becomes impossible to ignore, highlighting how paper pricing no longer reflects real supply conditions. The spread between futures and physical silver becomes a warning sign for institutions monitoring market stability. They recognize that once this spread widens beyond historical ranges, it signals an irreversible break between theoretical supply and the metal required for real-world use. Governments start paying attention when industrial sectors sound alarms about rising costs and uncertain access to silver. Policymakers consider interventions, but they face a fundamental problem. They cannot manufacture metal, and strategic reserves are far smaller than most assume. Attempts to stabilize the market through regulation or trading restrictions only increase anxiety. Participants interpret these actions as evidence that shortages are real, prompting more aggressive buying as everyone tries to secure silver before conditions worsen further. As panic spreads, mining companies find themselves under intense pressure to expand production. But many operations lack the capacity to increase output quickly, and new mining projects require years of development, leaving the market with no immediate relief. Exploration companies receive massive investment interest, but their discoveries cannot change the near-term reality. Even promising deposits take significant time to evaluate, secure permits for, and develop. The market must operate with the supply already available. Silver recyclers attempt to fill the gap, but recycling has practical limits. Much of the metal used in electronics and industrial goods cannot be recovered easily or economically, creating a bottleneck that prevents recycled supply from matching accelerating demand. Meanwhile, investors who once ignored silver begin noticing the growing disconnect between financial headlines and the market's actual behavior. They see shortages emerging, premiums rising, and delivery times stretching, prompting them to investigate further. As more people understand the developing imbalance, demand grows even faster. Individuals who previously bought silver casually now treat it as a protective asset, while new buyers enter the market seeking shelter from monetary instability and shrinking inventories. Financial analysts start publishing reports, acknowledging that silver is entering unprecedented territory. They highlight the ongoing deficits, dwindling stockpiles, and tightening industrial dependence, bringing mainstream attention to trends that specialists have warned about for years. This growing recognition draws in larger institutions. Portfolio managers who once dismissed silver as irrelevant now factor it into risk assessments, realizing that a supply crunch may impact multiple sectors and create ripple effects across the broader economy. As institutions accumulate exposure, the physical shortage intensifies. The available stock dwindles more quickly, creating a feedback loop where rising scarcity drives higher demand, and higher demand accelerates the rate at which supply disappears from accessible channels. Large industrial companies begin forming long-term supply agreements directly with miners, locking in output for years. This pulls future production away from open markets, leaving even less metal for investors and smaller manufacturers already struggling to compete. These contracts shift market dynamics dramatically. Once producers commit their future output to specific buyers, spot market liquidity falls, reducing flexibility and increasing competition among those still searching for unallocated silver in real time. The pressure now spreads globally. Countries reliant on solar expansion and electronic manufacturing raise concerns about strategic vulnerabilities, recognizing that silver shortages could slow infrastructure projects, energy transitions, and technological development across multiple industries. International trade tensions rise as nations begin securing their own silver supply chains, treating the metal as a strategic resource rather than a simple commodity. This geopolitical layer adds complexity, amplifying the urgency surrounding dwindling stockpiles. With supply chains tightening and industrial commitments expanding, market participants realize that Stage 5 is no longer theoretical. The conditions for a permanent structural shift have already formed, and the transition away from paper-based pricing appears imminent. The world starts to understand that silver's next move will not follow familiar patterns. The market is transitioning into an environment ruled by real scarcity, and once physical constraints drive prices instead of assumptions, everything built on the old system will have to adjust. Markets begin reacting to the tightening conditions. Traders notice unusual spreads across exchanges, with physical premiums rising faster than futures prices. These distortions hint that traditional pricing models are losing accuracy, unable to reflect the stress building beneath the surface. Investors accustomed to stable price structures now face a shifting landscape where each new data point reinforces the same message. Liquidity is thinning, inventories are shrinking, and delivery commitments are harder to fill, making silver one of the market's most unpredictable assets. As the gap between physical and paper prices grows wider, confidence in futures contracts weakens. More participants seek metal they can actually hold, realizing that owning claims is not the same as securing real supply during a developing shortage. Wholesalers who once relied on predictable shipments encounter delays and unexpected allocation limits. Their attempts to restock reveal deeper weaknesses, as suppliers struggle to meet rising demand with inventories that have already been stretched too thin across multiple industries. Smaller manufacturers feel the strain sooner than large corporations. They lack the purchasing power to secure long-term contracts and must compete in a tightening spot market. Their rising costs signal a broader industrial challenge spreading beneath normal economic indicators. Energy companies preparing for large solar deployments begin revising their projections. They adjust budgets, reschedule installations, and explore alternative supply routes, knowing that consistent silver access is essential for meeting renewable energy timelines already under heavy scrutiny. Electronics producers experience similar pressure. Device manufacturing relies on high-purity silver, and shortages begin affecting production cycles. Factory managers face difficult decisions as they weigh whether to reduce output, raise prices, or search for suppliers with shrinking availability. Medical technology companies raise concerns of their own. Silver plays a critical role in sterilization systems, imaging equipment, and specialized components. If shortages worsen, healthcare infrastructure could face delays in upgrading essential tools, creating risks beyond financial markets. Institutional investors recognize these cross-industry challenges and begin treating silver not just as a commodity, but as a strategic asset tied to national productivity and technological advancement. This shift in perception drives further accumulation from larger funds. As funds continue building positions, mining companies receive unprecedented attention. Executives participate in interviews, conferences, and analyst calls, explaining the structural challenges they face. Despite high interest, they cannot promise quick increases in output. Mining analysts release reports showing that even optimistic development timelines fall short of meeting the accelerating demand. These findings reinforce the belief that the market is entering a new phase dominated by physical limitations rather than speculative cycles. Countries reliant on technology exports begin forming strategies to secure stable silver access. Some explore partnerships with mining regions, while others evaluate stockpiling programs designed to prevent disruptions to their manufacturing sectors during growing scarcity. Trade negotiations increasingly include silver as a priority resource. Governments quietly discuss allocation rights, long-term contracts, and supply guarantees, acknowledging that access to the metal may soon influence economic competitiveness across multiple industries. These international moves send a message to markets. Silver is transitioning from an overlooked commodity to a strategic material. The recognition triggers additional buying, as investors anticipate long-term price adjustments tied to structural demand. Premiums across retail and wholesale channels rise further, revealing widening stress within supply chains. Dealers report fewer incoming shipments, and customers face limited product options, shorter availability windows, and higher costs for standard items. Online marketplaces reflect these changes with fluctuating inventory levels and inconsistent pricing. Buyers who once found silver easily now discover that securing even small quantities requires increased vigilance as supply becomes less predictable each week. Refineries feel the impact as well. Their ability to process recycled material does not keep pace with growing demand, and many operate at capacity. This limitation highlights the constraints of relying on secondary supply during tightening conditions. Financial media begins acknowledging the developing situation, though coverage remains cautious. Commentators highlight rising premiums, industrial concerns, and unusual market behavior, bringing broader public attention to trends previously discussed only within specialized circles. This increased visibility encourages new waves of investors to explore silver, many of whom are drawn in by the growing divide between physical and paper prices. They view the developing shortage as an opportunity, increasing pressure on available stock. Hedge funds, sensing volatility, begin repositioning their portfolios. They evaluate models built for stable conditions and adjust strategies to account for the structural challenges emerging within silver supply chains, recognizing that traditional assumptions may no longer apply. Large banks also take notice. Their analysts reassess exposure levels, reviewing delivery obligations and potential risks within futures markets. Internal reports warn that disruptions may escalate if physical shortages begin impacting contract settlements. Amid these developments, volatility increases. Price swings widen as traders attempt to interpret rapidly shifting signals. Some believe a breakout is imminent, while others expect a temporary correction, but both sides acknowledge that underlying conditions are becoming increasingly unstable. Outside of markets, public interest grows steadily. Educational channels, financial commentators, and alternative media outlets discuss silver's tightening supply, prompting more individuals to investigate its role in modern technology and monetary systems. As demand accelerates from investors, industries, and institutions, silver's next phase becomes clearer. The market is approaching a point where supply constraints take full control, pushing the narrative away from speculation and into the reality of physical scarcity. This convergence of factors drives the market toward the heart of Stage 5, where paper structures face their ultimate test. Every signal points toward a future where real-world limitations dictate value, marking the beginning of silver's most consequential transformation yet. Silver's tightening conditions begin influencing broader economic sentiment. Analysts notice correlations forming between supply stress and market volatility, suggesting that disruptions in this single metal may soon spill into areas far beyond commodity trading or industrial inputs. Investors monitoring global risk indicators observe how rapidly silver's behavior is departing from historical norms. The market no longer responds to familiar catalysts, instead reacting to physical constraints that shift without warning as inventories decline and competition intensifies. Large manufacturers begin reassessing long-term production forecasts. Their planning departments revise expectations for component availability, understanding that silver shortages could alter output potential for entire product lines, especially those central to energy, computing, and advanced communication. Governments increase their involvement as domestic industries request support. Officials meet with corporate leaders, mining representatives, and financial advisors to explore solutions. Yet every conversation circles back to the same problem: there is simply not enough metal available. Attempts to boost domestic recycling programs face limitations. While helpful, these initiatives cannot solve structural shortages because most silver used globally becomes dispersed across countless devices, making meaningful recovery difficult and too slow to match accelerating demand. Market participants begin realizing that silver's scarcity resembles a slow-moving storm building strength each month. Its progression is not sudden but steady and consistent, pushing the market toward a point where familiar frameworks struggle to explain emerging conditions. The futures market displays increasing instability. Contract holders grow anxious about guaranteed delivery fulfillment, leading some to close positions early or shift to other assets. Their caution reflects growing uncertainty regarding the reliability of paper-based promises. Physical dealers respond to dwindling inventories by tightening purchase limits and prioritizing established clients. New buyers struggle to access supply, further widening the divide between market participants who secure metal early and those reacting only after conditions intensify. This unequal access creates opportunities for arbitrage, but only temporarily. As available stock diminishes, price discrepancies shrink, not because markets regain balance, but because nearly all channels face similar shortages, erasing earlier pathways for opportunistic buying. Hedge funds begin adjusting strategies again, shifting from short-term trades into positions designed to benefit from long-term scarcity. Their models highlight silver's unique combination of industrial necessity and limited supply, prompting deeper involvement from major institutional players. These strategic shifts draw increasing media attention. Commentators describe silver as a developing pressure point within the global economy, noting its rare ability to influence industries, supply chains, and investment markets simultaneously. As shortages worsen, public interest expands accordingly. Individuals who once viewed silver casually now investigate deeper, learning how essential the metal is across modern technology and renewable energy. This education fuels new waves of buying, compounding existing supply challenges. With more participants entering the market, the notion of silver as a simple commodity fades. People begin recognizing its strategic importance in a world increasingly dependent on electrification, advanced communication, and sustainable energy infrastructure. As understanding spreads, analysts outline scenarios showing how Stage 5 may unfold. Some models predict rapid price acceleration once paper markets lose control, while others anticipate disruptions spreading slowly through industrial sectors before translating into broader pricing shifts. Regardless of speed, all projections share a common foundation. Physical scarcity becomes the dominant force. The market transitions from a system driven by speculation and expectation to one shaped by the undeniable constraints of real-world supply. This transition challenges long-held assumptions. For decades, participants believed futures markets could manage supply imbalances. But declining inventories reveal that paper structures work only when physical stockpiles are strong enough to support contractual obligations. That competition pressures prices upward, but more importantly, it shifts the psychology of the market. Participants realize they must act earlier, with greater certainty, because hesitation carries increasing risk as supply channels grow unpredictable and inconsistent. The recognition of this risk becomes widespread. Financial institutions update guidance, advising clients to reassess their exposure to commodities vulnerable to structural shortages. Silver sits at the top of many lists due to its essential industrial role. Even conservative investors reconsider their positions. They examine long-term charts, supply data, and industrial forecasts, concluding that silver's trajectory is unlike typical commodity cycles. Its shortage is supported by mathematics rather than speculative enthusiasm. Strategic sectors begin preparing contingency plans. Energy, electronics, and medical industries explore alternative materials, but most replacements lack silver's versatility and performance. reinforcing the irreplaceable nature of the metal in critical technological applications. Policymakers attempt to calm markets by promoting research into new mining regions and enhanced recycling infrastructure, yet these solutions remain years away, offering little relief to the immediate and growing pressure facing global supply chains. Meanwhile, storage facilities continue reporting reduced inventories. Audits reveal declining volumes across multiple regions, confirming that the remaining available metal is being absorbed quickly by industrial buyers, funds, and individuals seeking security during tightening conditions. Attention turns toward the tipping point itself. Analysts debate which catalyst will trigger the break: a large industrial order, a geopolitical disruption, or a sudden acceleration in investor demand. Any single event could push the system past its capacity. As the final pieces fall into place, the market approaches the moment where scarcity overrides theory. Stage 5 becomes not just possible but inevitable, marking the beginning of a new pricing reality shaped entirely by the physical limits the world can no longer ignore.